So, good evening, friends. Thanks for joining in. I'm Pallavarajan and I'll be the moderator for today's webinar. And it's my pleasure to welcome you all for today's webinar. So, among us, we have Mr. Andrew, who's a CEO, and eventually we'll also have Mr. Abhay, who's the MD and fund manager for Avendus Capital Public Markets Alternative Strategies. And today they will share their insights on the markets, and thereafter they will introduce and briefly take us through Avendus India Large Cap ESG PMS strategy. So before I hand over the forum, I would like to give a small brief about Avendus Capital and also intro about our distinguished guest. So Avendus Capital Public Market Alternate Strategy is the investment manager for AF Cat 3 funds under the wide group of Avendus Capital, a financial institutions covering a wide area of financial advisory, wealth management, structured credit solutions, and alternative asset management. And Avendus Capital are cohesive unit with over 100 years of cumulative experience investing in Indian markets. Highly experienced professional comprising of ex-Merrill Lynch fund managers from the strategic risk group. Largest head fund managers in the country managing 643 million USD across long short strategies with an impeccable team track record over 15 years in the Indian equity markets. And about Mr. Andrew, Andrew is the CEO of Avendus Capital Public Market Alternative Strategies. Prior to joining Avendus, Andrew was the CEO of Ambit Investment Advisory, where he built one of the India's largest and most successful hedge funds. He also was a managing director, strategic investment group for Merrill Lynch in India. Andrew was a chief administrative officer and head of research at Merrill Lynch in India. He successfully built DSP Merrill Lynch to be rated a research broking house in Asia Money, institutional investors, and Greenwich. He has also worked with Barclays and Credit Suisse earlier. Welcome, Mr. Andrew.
Thank you.
About Mr. Abhay. So Abhay is a managing director and fund manager at Avendus. Abhay joined from Deutsche Bank, where he was a managing director and head of equity research. With an experience stretching close to quarter century, Abhay is a veteran in Indian capital markets. Having seen their evolution since they've been liberalized and open to foreign institutional investors post the 1991 reforms, at Deutsche Bank, he spent a decade overseeing research coverage of more than 120 stocks across sectors, lead covering Indian metals companies and writing Indian equity strategy. Abhay has been highly ranked analyst and strategic, and prior to Deutsche Bank and JP Morgan, Abhay worked with Citigroup, DSP Merrill Lynch, HSBC, and Barclays. And welcome, Mr. Abhay. So over to you, Mr. Andrew and Mr. Abhay.
Well, thank you, and thank you for your warm introduction, and good afternoon, everybody, on the webinar. Unfortunately, I can't see all of you. That would have been nice, but there's quite I can see there's quite a lot of you. So thank you for your attendance and interest. So what I'm going to do is just briefly talk about the markets, and then get into the product itself of ESG. So for the markets, I'm just going to talk a few things globally. A little less locally, because I'm sure you know some of it, but I will touch briefly on that as well. So what we did, or what we were thinking last September, October, just to kind of step back so I can talk about what we're thinking today, was that we had to decide, how we would see 2021. So we worked on the basis that President Biden would become the president at that time, and a vaccine, would be established. We thought maybe the first quarter of this year. Anyway, it came earlier than we expected. So with those two things in place, we then said, okay, we know one thing, is that central banks and governments are going to be, continue to be accommodative. Interest rates are going to remain lower for longer, and global growth would start to pick up. But when investors looked around, and they could see that, they can still see growth in markets, they're getting no yield. So where would they look for that? So when they look for growth in yield, they would come to emerging markets. But we felt they would concentrate more so towards Asia, because we believe Asia will be the kind of engine of growth over the next 5 years for global growth. And part of the reason behind that is that we think millennials will have the spending power over this time period. And just to give you some stats on that, there's about 60 million millennials in the US, whereas both China and India each have 320 million respectively. So you know where the kind of spending is going to happen over the next 5 years or so. So monies would flow to emerging markets as global growth started to pick up, but in particular towards Asia and India, because of its weightage, would see quite a lot of foreign inflows as well. So that was the basis of how we were thinking coming into 2021. And to be honest, that's become pretty much consensus now. That always kind of worries me a little bit, but because of the longer term trends, we feel comfortable with that theme, in the next 2 to 3 years, minimum at least. So that's the backdrop to coming in. And then the other two things we thought about was what would people do once they had the vaccination, and would they spend money, would they kind of save it for a rainy day? And our view is that people will spend. I mean, I speak to a lot of people in the US and particularly UK from all my friends and relatives there, and everyone's just fed up. They want to get out, they want to spend. And if you take last summer, what happened in Europe and the US, that's the pattern we expect to see. People will get out very quickly and start to do things that they normally would like to do. So, expect a big pickup in spending in the next 6 to 9 months as lockdown eases. And if I take the UK, for example, they should have full exit from lockdown by the middle of June, if all goes well. So that was the other thing which we'd be driving markets and earnings over the next 6 to 9 months. And obviously, having Biden there would mean President Biden would see more money spent on infrastructure, and that would be replicated globally. And we've seen it already in India through the budget. So those were all the positives. The risks we saw, and in no particular order, but there's a lot of expectation that President Biden and China would get on a lot better than Trump. But we don't know the answer to that yet. And if President Biden's a little more harder in his stance towards China, there's a risk there to the global trade kind of pickup that we're expecting. So that's one risk. The second, which is probably more relevant today, is with all the spending that we're expecting, it could be inflationary. During the summer months, as people start spending more and more money, and that's one of the things that we are concerned about, have been concerned about. Now, will central banks increase rates very quickly? Don't think so. They're equally as worried. If you whilst the Federal Reserve Chairman Powell has been, talking down inflation, and we do agree with him that a lot of the inflation you're seeing now is transitionary because it's increasing commodity prices or shortage of containers, which is pushing prices higher. But it doesn't necessarily mean it's always going to be the case. I think if unemployment falls drastically and employment picks up, then that's where I can see the kind of inflation impact coming a lot quicker. And that would obviously start in the summer months onwards. So that's something to keep an eye on. But again, I don't expect the central banks to act so quickly. But what the markets will do is try and price in that risk of when the central banks might start to want to increase rates. And remember, increasing interest rates or rates moving higher would have a big impact on corporates, particularly in the US, which are highly indebted. So that's the risk. It's a credit market risk, which we want to look for. And the third part is it's a question I keep being asked is there a bubble in the US because of all the asset prices which are rising? The one area that does concern me is these new special purpose acquisition companies, which basically get listed They then say, you know, they're going to do this or do that, go to the moon and back in terms of expectations, and then acquire companies. Now, it's working at the moment, but once that doesn't work, you know, that could cause a few problems, particularly in that kind of area of technology, which they're kind of focusing in on. So I'm a little bit concerned on that, and that's where you could see some form of a bubble. But for India, I don't think we fall into that category. I think the earnings momentum is very strong for the next 2 to 3 years, as far as I can see. And whilst it's mentioned I've been in India a long time, usually the budget doesn't excite me. The last one that did was 1998 under Chidambaram. But I must admit that this one is right up there with that, in terms of that the economy, which we're starting to see to pick up, you know, is now being given a good push as well by the finance minister in terms of infrastructure spending, and all of that will have multiplier effects across many parts of industries in India. And obviously, that operational gearing, you know, effect as companies manufacture more or do more services will flow through to the bottom line, which means that earnings can continue to rise and be upgraded over the next 2 years. So that fills me with more confidence that India will be, you know, shining in part of the Asia pack going forward. So I'm a little less worried about, you know, the valuations in India, because I think if if we were 3 years on having this conversation, then I think you would have found that the market is probably cheap given the earnings expectations that we're thinking about. So that's what we're thinking about at the moment in terms of India. So, you know, if there's a time at the end, happy to answer any questions. In terms of ESG, you know, Avendus was one of the first funds to launch a ESG fund in India. We thought about it very, very early on in terms of you know, the potential and obviously the investment process that would take place going forward, and that's starting to play out now. So there's been a lot of funds recently been launched, and nothing in terms of what they do, but Abe, I think, you know, has been a leader in this field, and what he's done is not just, you know, doing an ESG scoring, it's what you do after that, which is the key to picking the right stocks, to looking for that kind of impact and sustainability of companies, which, you know, just a broad filter doesn't really help you. It's all the questions you need to ask companies and get a real kind of full circle of answers before you say, yes, this ticks my box in terms of all the parameters. I won't dig into too much more because Abe has everything at his fingertips. So I'll pass it over to him. But you know, I would just want to emphasize that it's not just the scoring part of it, all the hard work that you go into exploring each and every detail, which is important. So Abe, over to you.
Thank you very much, Andrew, for that very kind introduction and that excellent introduction into what ESG is, and speaking about the pioneering role of Avendus in bringing ESG to India. Thank you also very much to PMS Bazaar for giving us the opportunity to speak about something that we are very passionate about and which we want to raise the bar on in India. Before I go into the presentation, I was just seeing some data a couple of days ago, which I want to highlight, which will set the tone for our presentation and our Q&A sessions, which will follow. So the latest data is showing that in the year 2020, close to over $50 billion has flowed into ESG funds, ESG ETFs, and this is almost 100% or double of what the figure was in 2019. And this is not all. As a result of the surging investor interest in ESG, European sustainable funds are breaking new records in terms of inflows, assets, and product development. In fact, many funds are repurposing themselves now as ESG, given that there is very, very strong investor interest for ESG funds and the ESG style of investing. So having given this brief background, let us go into the presentation. Riddhi, can we please go to the slide which starts with what ESG is not? So we thought we will start with this slide because there are a lot of misconceptions associated with ESG. And it's best to just quell those misconceptions at the very beginning and provide a perspective of what ESG truly is. So what is one of the single biggest misconceptions? The first and foremost misconception is that when you look at ESG, portfolio returns are sacrificed. And a corollary misconception, ESG is only about managing risk mitigation. Now, let me tell you that nothing could be further from the truth. Portfolio returns are not sacrificed. In fact, ESG is a source of alpha generation, and we will speak about that in a bit. What I also want to say at this point in time is that ESG or integrated ESG is not about saving the world. To save the world, you look at ESG, but you look more at impact investing. Under impact investing, the objective is singularly on delivering the impact. There is no corollary, there is no simultaneous objective on alpha generation. And this is what brings us to the world of integrated ESG investing. Integrated ESG investing is the way we see it. Integrated ESG investing is another style of investing, which is becoming more and more prevalent. This is very similar to value investing, growth investing. And I think with the big inflection points that we are looking at, into the world over the next few years, the ESG style of investing or the integrated style of ESG investing is going to gain further and further momentum. And under the integrated ESG investing, by investing in sustainable companies, you do tend to achieve a sustainable impact, but the key objective or one of the core objectives is the creation of alpha. So having talked about this, and I will keep referring to this point, that the integrated ESG investing should be seen as a style of investing, like value, like growth. And this will be the style of investing which more and more funds will look at. And therefore, investors who come early into these funds and have a very decisive approach to it will be big beneficiaries. Riddhi, can we go to the next slide, please? So very basically, let's look at what ESG is. So ESG is nothing but a 360-degree analysis. It goes beyond the traditional approach. In the traditional approach, we tend to largely look at the financial statements. We will look at other factors such as demand, supply, etc. ESG goes beyond these traditional factors. So let me put it this way. A company interacts with various stakeholders. It doesn't interact only with its shareholders. Under the traditional investment style, you generally look at a company and its relationship with shareholders. But under ESG, you move to a 360-degree view where you look at a company and its relationship with all stakeholders. So shareholders are but one stakeholder. So who are the stakeholders? The stakeholders are the society in which a company operates, the environment which a company is part of, the government in whose domicile the company is operating, and its employees, which are a very core element of who the company is, and of course, the shareholders. So what ESG therefore does is it goes beyond the traditional factors. It looks at a company and its relationship with all these stakeholders. And I think what therefore really comes out, it's no magic. It's not that, there is this black box of ESG, but what really comes out when you do this 360-degree analysis is a far more detailed approach, which probably will give you an idea of the opportunities that lie ahead, the risks that lie ahead, and most importantly, it helps you assess how resilient the company is. And these are the reasons why ESG becomes a source of alpha generation. It's an additional lens which goes beyond the traditional approach. I won't go into the details that you see on the spreadsheet. These are some of the things that ESG funds look at. And in our illustration on the process, we will have far more details. So I won't spend any time on this any further. Let's go to the next slide, please. So coming back to, does ESG deliver alpha? As we said, ESG delivers alpha. There is a lot of global evidence. But let's look at the Indian evidence. And what we have demonstrated here is the evidence from our own fund, which we had launched in February. And since over the last few months, we are still tracking the performance of this fund. So since February of 2019, the Avendus India Large Cap ESG strategy has delivered a 32% return versus the benchmark of 25%, an outperformance of 7.4%. And I think all of us, will appreciate the fact that the last year particularly has been a roller coaster year. We've had a global pandemic, we've had a regime change in global monetary and fiscal policy, we've had liquidity pouring into the markets. So, everything that you could conceive of over a long cycle has actually happened in the last few months. And therefore, to us, this outperformance gives us a lot of confidence, not only in ESG being a source of alpha generation, but the very, very detailed work that we do and our own ESG process. As Andrew referred to in his introduction, we've got a very, very detailed proprietary approach to ESG, which goes far beyond traditional ESG rankings, which are put out. In fact, rankings, as we will talk about, are a very small component of our investment process. Can we go to the next slide, please? So having spoken about the broader picture, the overall picture, let's now go and discuss, what is the Avendus India Large Cap ESG strategy. The objective of, our fund is to provide investors with opportunities for long-term capital appreciation with lower volatility through investing in companies that practice sound ESG policies. So as I had spoken earlier, ESG is an investment style, and the core objective of the integrated style of investing, which is borne out in our objective as well, is to generate long-term capital appreciation with lower volatility. So returns are one of the core objectives, together with, of course, delivering the positive ESG impacts. So let's now speak about the investment strategy. What we look at is a high conviction, low turnover portfolio of 15 to 25 stocks, where we integrate the ESG factors alongside mainstream company analysis. And I'll speak in more detail when we talk about the process, how we do it. Our objective is to invest in companies that are durable compounders with strong moats, generating sustainable long-term growth, where we deem valuations are supportive variables. So what I'm trying to say over here is that when you look at ESG, the returns are captured over a longer term period. And when I refer to this, I don't mean that investors need to be patient to get the returns. Investors will see the returns, every year. So what we are trying to say is that to get the true benefit of ESG, you've got to be invested over a longer period where you see alpha generation year after year on a sustainable basis. Let's go into the next slide, please. So let's now come to the investment process. At the outset, I'd like to mention that the India ESG Fund, the Avendus India ESG Fund, will not invest in tobacco, alcohol, fossil fuels, and weapons. And the reason why we say no to fossil fuels among tobacco, alcohol, and weapons is that the world is changing. And what we are seeing around the world is a stress on decarbonization as the world moves towards mitigating climate change. Climate change has moved out of textbooks, but into the real world, where in their daily lives, citizens are looking at climate change mitigation. And we've reached an inflection point where regulators are ready to act. And what you are beginning to see already, and this is even before the world has moved to net zero targets and net zero commitments, investors around the world are shedding fossil fuels. We've seen the MSCI Global Oil and Gas Index, the integrated oil index, being down almost 20 to 25%, while markets continue to move up all over the world. So clearly, the world has started moving towards shedding fossil fuels. And when we come, to more slides, I will talk about why it is so relevant in India. Let's go to the next slide, please. So for ESG, what we do is, for ESG, you need a lot of data. So apart from all our own analysis, for our data, we rely on MSCI. Now, as all of you must be aware, there are two companies in the world. They're called ratings companies, but I think more than the ratings, it is really the kind of ESG data that they provide, which True Blue or very detail-oriented ESG funds like ours rely on. We don't rely on MSCI for their ratings as much as we rely on them for comprehensive ESG data. So MSCI is the vendor we have chosen. They have ESG analysis of close to around 200 plus companies, and that will be going higher to almost 300, 350 companies. So they have a reasonably comprehensive data set. And I think what really interested us with MSCI was they look at India and Indian companies in a global context. So Maruti's ESG is benchmarked to Daimler or Ford, or HDFC Bank's ESG information analysis rankings are benchmarked to JP Morgan, Deutsche Bank, Citigroup. So, it kind of gives us a very international context. And of course, the corporate governance details are based on Indian laws and, Indian corporate governance norms. So it gives you a very, very detailed, approach, together with, of course, the rankings that they provide. Can we go to the next slide, please? So now let me come to the investment process. And what I want to really talk about here is that our integrated ESG investment process goes far beyond the rankings. We spend a lot more time doing our own ESG analysis than just rely on the rankings which are provided by MSCI. So what we do is our universe is the top 100 companies. This is the Nifty 100. On this Nifty 100, the first very basic screening approach, this is just a screening approach. We look at MSCI's ESG rankings. We do look at rankings over here. And what we do is we look at all the rankings and we just eliminate from this 100 those companies which are ranked B and below. So this pretty much out of 100 takes out about 35 odd companies, together with many of the companies that I spoke about in the sectors that we will not invest in. Now, the work really begins. On these 65 odd companies, we will do a very detailed financial analysis. And this will be your traditional financial analysis, but given that we are looking at companies which are going to be durable compounders, we will look at the details such as brand, distribution, scale, cash flows, and I'll talk about the variables in a bit. And for this, we have a cornerstone return on capital employed approach. We want companies that have delivered a threshold return on capital employed in double digits, and which we think the company is going to be capable of delivering in the forecast period. So there's a very detailed work that is done on the ability of the company to be able to sustainably, and here I use sustainably as durably generate a high return on capital employed. And of course, a qualitative analysis will look at responsible and resilient companies. So this process will take us from 100 stocks to 30 to 35 stocks. Can we go to the next slide, please? Now, our detailed work on ESG begins. So on these 30 to 35 stocks, we will look at integrating all the ESG information. And trust me, I'm talking about close to 150, 200, I'm not sure what's the number, but it definitely looks like, a lot of variables. There could be 100, 150 variables across E, S, and the G. And we integrate many of these variables into our financial analysis. And then we basically look at how this ESG information, how these ESG factors will stand out, giving you both an opportunity as well as the potential risks. And this is something that ESG rankings will not allow you to do, because rankings are information at a point in time. It is information. The rank is derived on information, that is available for that particular year. And our experience showed us that many companies that are ranked very highly did not withstand the rigor of our detailed ESG analysis on risk criteria. There were many risks that we saw in those companies when we did the very detailed ESG analysis, which is not captured in the ranking. So, some of these companies are very good on corporate governance. They're doing all the right things on sustainability, but they are not able to address some very, very relevant and very, very real ESG risks, which could, completely sidestep the managements from these companies. And trust me, many of those risks are coming, and we'll speak about that in a bit. So what we therefore do, and I'll talk about some examples when I come to our raising the bar section. But what I want to leave over here, the message I want to leave on this slide, is that rankings are a very small component of our ESG approach. We do our own ESG analysis, which is very, very detailed. A lot of the information for this comes from MSCI, but we do our own as well. And finally, after applying all of this, we will finally construct our portfolio of 15 to 25 stocks. So I have demonstrated we move from 100 to 65, 65 to 35, but on the 35 companies, there is some very, very detailed and rigorous ESG analysis that goes in. And over the last 2 years, we have been honing this approach. We are consistently learning, and we are bringing in many of these new things. And honestly, there's something or the other that is coming through every day. So it's a very, very well thought out approach. Can we go to the next slide, please? So what are some of the financial attributes? Because as I said, ESG is an investing style. It's not that you're investing in companies waiting for the returns. We are investing in good quality companies which are stand out on their fundamental and ESG factors. So what are some of the financial attributes of these companies? Most of them have a sustainable return on capital employed in excess of 12%, have durable double-digit earnings growth, low leverage, low working capital requirement, durable operating cash flow, etc. This is what we get. Now, I'm not saying that we are going to be fussed about many of these variables, because with the shift in the markets, we may need to look at sectors which have not had a very good run in the last few years, but which we believe will be the drivers of the markets over the next 5 years or so, aided by this regime shift in global monetary and fiscal policy, and of course, India's focus on growth. So for many of those sectors, we may need to look at the variables, but clearly the ESG variables will very well be there. Maybe we could make a shift in some of the fundamental variables. Let's go to the next slide, please. I now want to talk about this raising the bar. So what do we do which is different? And what I want to say over here is that we are the pioneers on ESG, and we want to set the benchmarks for ESG investing in the country. And we, therefore want to raise the bar on how ESG is done. So I'm giving an example over here. Let's look at a live example. How would you do an ESG integration for the banks? What are some of the variables that we look at? And let's start with the evidence on governance. So governance is, of course, pretty common. So I won't spend too much time, but we look at board diversity, look at compensation committees. We will look at does a bank incorporate sustainability performance in pay policies? And another thing that we are now going to incorporate is climate risk. What level of climate risk is the bank incorporating in these risk factors? And we understand that in the next month or so, many Indian banks are going to be releasing climate risk assessments. They're going to highlight what is the carbon risk to many of these banks. And I think a lot of this disclosure is going to come out, and we are going to increasingly be looking at that. As far as the evidence on business responsibility is concerned, we will look at data policies of the bank. For example, does the bank have a data protection policy? Is there an employee training done on financial protection? Cyber security, that is very, very important. All over the world, we are all using data, very excited about data and technology, but we are not taking into cognizance the many risks that this big use of data can bring, and that is cyber risks. We've seen what cyber risks can do to company stocks. We've seen examples of what's happened in Europe, in the United States. Many stocks are down almost 10 and 20% after cyber attacks. And many stocks do not recover for a long, long time because a lot of data integrity has been compromised. So when we look at Indian companies, we look at various factors on cyber security, such as, does the company have a cyber security policy? Who is in charge of that policy? Is cybersecurity part of the risk officer's mandate? What happens if there is a cyber breach, etc., etc.? And we not only look at these variables, but we generally ask the companies many questions on this. We recently met the CEO of a top 3 private sector bank, and we asked him this question. And he said, no one asks me this question, but let me tell you that more than NPLs, I'm really worried about a cybersecurity related issue hitting the bank, or some kind of a problem with the technology, our systems. So, these are very, very important, very, very relevant issues. And traditional analysis doesn't really look at these, but ESG looks at many of these variables. Can we go to the next slide, please? So this is on the evidence of the environment-related issues. So, amongst other things, we will look at what proportion of overall financing is done to environmentally sensitive sectors. How are management systems assessing these ESG risks in financing activities? If it is a corporate bank, if the bank is lending to a project, an infrastructure project, we will ask if the bank has done what is called an impact assessment report. And in that impact assessment report, we will ask if the bank has looked at the climate variables. Now, say for example, you are building a coastal road. We have a coastal road coming up in Bombay. The question we will ask is that while evaluating this coastal road, did the impact assessment report look at potential tide levels, sea tide levels in India? And then we will go even further, saying that when you looked at these sea tide levels, did you look at just the past, or did you take into consideration the next 50 years? Because all the evidence on climate change is suggesting that sea levels are going to rise, and Bombay is going to be materially impacted alongside Calcutta and Cochin on account of these rising sea levels. So this is the kind of detail, this is the kind of analysis that is done. Now, to a traditional investor, this may look probably as being excessive, but to us, in the world that is changing, in a world where investment drivers are changing, ESG style of investing, the integrated ESG style of investing will stand out. And I think, this style will probably help us in consistently generating a positive alpha. So, let's go to the next slide. What I want to say is that our work just doesn't end with analysis. Our work goes on in ESG. Engagement and stewardship are vital pillars of the ESG framework. We have a stewardship policy, and our stewardship efforts are to engage with company managements, voting proxies. We have an in-depth knowledge of our investee companies, the most material ESG issues that which should be evaluated, and what we are really looking for. And there are many issues such as climate change, cyber security. We want to be the agents of change, helping the companies to be tomorrow ready in a fast changing world. Because these are going to be the factors that are going to make a difference. We have one more slide where we'll talk about raising the bar. And I want to really highlight this. Our view is that if you want to be a true ESG fund with integrity in a country like India, you have to perforce tell the investor what is the carbon footprint of the ESG portfolio. Because India is the top 5 countries in terms of climate vulnerability. And we understand that India is looking at making an announcement on reaching net zero targets way ahead than what China has set. And as and when that announcement comes, there are going to be a lot of government policies around decarbonization, which will have a significant impact on many fossil fuel companies. So what we are doing at Avendus is we are actually calculating the carbon emissions of our portfolio. And I'm very happy to say that the carbon emission of the Avendus ESG fund portfolio is 72% lower than the corresponding Nifty benchmark. For us, it's a Nifty 100. And on carbon emission intensity also, we are 58% lower than the Nifty benchmark. Our endeavor is to consistently improve on this. But this is something that we very strongly believe in, and we think that every ESG fund in India should be declaring the carbon footprint of their portfolios. I think that is the least an ESG fund can do in a country like India, where carbon is materially relevant. And I'm happy to say that we have set the benchmark. At this point in time, based on the disclosures of many other ESG funds in the country, I really haven't seen anyone else disclose their carbon footprint or portfolio's carbon footprint. And I'm very happy to say that we have raised the bar over here. I do wish that all the other ESG funds in India start disclosing their carbon footprint. Can we go to the next slide, please? So, even in terms of the ESG scores, etc., our portfolio, the Avendus ESG portfolio, stands out relative to the NSE 100, and on both the ESG leaders. In terms of, when I say ESG leaders, having some of the finest companies on ESG factors relative to the benchmark, and that's on the ESG scores as well. So clearly, there is a superior overall portfolio ESG score. Can we go to the next slide, please? So let me, just refer to the performance track record of the fund. So I think I already referred to these gross returns. Since inception, the fund has delivered a gross return of 32%. Versus a Nifty of 24%, giving an outperformance of 7% plus. Riddhi, can we go to the slide after this? Yeah, this one. So what I want to talk about here is that on the net returns, we have come up with our fee options, which either Bhautik or Mansi will talk about. But when we look at those fee options, the post-fee alpha under those options, I've got the details over here. Since inception, under those options, it is 2.8, 3.2, and 5.7%. And I won't go into the details, but if you see, over the last 12 months, over the last 18 months, and since inception, under each and every one of those options, the fund has generated a post-fee alpha, and our endeavor will be to widen this moving forward. That pretty much brings me to the end of this presentation. Yeah.
Thank you, Mr. Abhay, and also thanks to Mr. Andrew. Thanks for such an insightful presentation. I liked your clarity and gravity of this presentation, and so the investors and the participant, hopefully.
Thank you.
So we have started almost 15 minutes back. We hardly have 10 minutes for Q&A session. If possible, we'll try to have it for 15 minutes. As a process, we used to collate the questions from, during the registrations, and we have a couple of questions which has been collated. And then if we have time, we'll move on to the forum questions as well. So you can choose either Abhay or Andrew, you can choose the question to address. So let me start with the first question. ESG concept is relatively new to India, and what's your outlook for next 5-10 years for ESG companies?
Andrew, do you want me to answer that?
Yep, go ahead, Abhay. If it's ESG, go ahead.
Thank you. Thank you. The outlook, in fact, is very, very good in our view. And the reason is that there are, many disruptions which are happening in front of our eyes, which are going to be best addressed through ESG funds, primarily because of the ESG style of investing, which goes beyond the traditional approach. Now, let me give you the one example. All the large systemic events we've seen in the past were financial events. You have the global financial crisis, we have the Asian financial crisis, we have the tequila crisis, we had the SNL loan problem, etc. But the pandemic last year was a physical risk. Now, we saw that a physical risk like a pandemic could have such a huge impact on markets. The next big physical risk that everyone now wants to avoid is climate change. And I think this is one of the reasons why there's going to be a lot of regulation, coming out beginning this year itself. And I'm not going into the details, but this year itself, we are going to see a lot of government regulation on additional ESG disclosures, climate-related risks. And what we understand is most of the world is going to come out with a carbon tax, on polluting sectors, on sectors which are very high emissions. And this is going to lead to a massive polarization on sectors. And if you're not looking at ESG, then you're going to probably be holding on to many of those sectors which are going to be at the center focus of negative, excessive government regulation. So from an India perspective, therefore, we think that the next 5 to 10 years, ESG is really going to take off. And, we are at an inflection point today, and it's only going to take off very significantly.
Great. Thanks, Mr. Ahab. I hope Mr. Andrew would be taking this question. After the uncertainty created by COVID, how do you see 2021 for the consumption space? Also, after the recent rally, how comfortable are you with the valuation in this space?
So it depends on consumption. You meaning more FMCG type companies?
Yes.
Yeah. So, I mean, the good news is that they've done very well during the COVID times. But as the economy starts to come out of starts to recover very strongly, and what we said is that the valuations on the consumer companies or consumption companies is very, very high. And what we expect to see is a broadening out of the kind of indices and sectors over the next few years. And those sectors which we think will be the leaders now, because they're going to see the biggest growth and operational gearing and everything else that will play out, which I mentioned before, would be in the banking or financial sector, overall financial sector, energy, industrials, and consumer discretionary. Those would be the sectors which I think will lead the market going forward. Now, on your consumption stocks, they will rise with the market. If you look at any bull market, you'll see IT and consumption, but they're going to relatively underperform compared to the other sectors I've just mentioned. So nothing wrong with the companies. People still will want to eat and want to do everything else. But because of the valuations and because of the growth compared to other sectors, it's going to be quite low. And therefore, relatively, they will underperform both the index and other sectors going forward.
Great. Thanks, Mr. Andrew, for addressing that. So the next question is that, I could see there is a popularity in ESG space. There have been a couple of NFOs which has come in the mutual fund space as well. So keeping that in mind, there is a couple of ESG offerings in the mutual fund space. How different is Avendus India large cap ESG PMS when compared with other ESG mutual funds?
So I'm just going to jump in on that one because, Abe, we could say being a fund manager would be quite biased, which would be fair, right? But I think what we try to emphasize without going into or talking about other mutual funds in particular is that, whilst they're all using MSCI for their rankings, which is what they're doing. They're just taking MSCI rankings and then putting it into their portfolio. What we're saying is that, yes, there's rankings and there's scores. We do a lot more work underneath that in talking to companies in terms of what's happening globally and how it could affect India. And we have a lot of companies which will not fit our criteria, which will be in their criteria, right? Now, I'm not saying who's right or wrong. I'm just saying what we do. So we think we do a lot more work, and because we were one of the first to do this, nearly 2 years ago now, there's a lot of areas which we've discovered become more and more important and prevalent to getting that alpha, which which Abe demonstrated, and that can only increase from here. So being ahead of the pack, and I'm not saying that they won't do anything good, I think has given us that kind of lead over these kind of new funds, because they will still have to do a lot more work going forward, which we've already been doing for nearly 2 years.
Great. Thanks for that. So we'll move on to the next question. How does Avendus India Large Cap ESG PMS provide the opportunity to the investors in contributing to the environment and sustainability?
Right. So as I mentioned, and I think this is a very, very good question, because it allows me to bring in the materiality angle, because ESG is a very wide concept. It's not a one-size-fits-all approach. For ESG to truly do what it needs to do is deliver the sustainable impact together with generating the returns. And of course, the returns will be generated if you are able to address sustainability, is you've got to look at country-specific factors. So, what are the country-specific factors? And we spent a lot of time. So our strategy is actually premised on identifying certain country-specific factors and then working on the whole process. So what are the country-specific factors for India? Water security. And I won't go into the details. We all know how significant it is. Pollution. We all know, how badly India is getting impacted by pollution, and how many premature deaths happen on account of the pollution. And of course, we've got the carbon emissions. So what, as I said, we have done is by addressing these materially relevant environment risks. Of course, there are other material risk factors such as cybersecurity, but your question is on environment. By bringing in these in our stock selection, when we are doing the environmental analysis, we'll see how companies stack up, on these variables. And I won't give the name of this company, but there is a certain auto company which is not in our portfolio, because that company only has an exposure to the diesel engine, which for us is a very big risk factor from an environment perspective. And when I said that, we are providing a carbon footprint of the portfolio, this is how we demonstrate to the investor the integrity of ESG, and particularly on the relevant factors such as carbon, pollution, and emissions.
Wonderful, Abhay. So let me take one last question from the forum. Will you purchase shares like Asian Paints, where raw material is hazardous, and Reliance Industries business include refineries, which is harmful to the environment?
Right. So on Reliance, unfortunately, until the O2C business is hived off, Reliance is uninvestable, given that the consolidated entity, given that the company right now has a significant amount of earnings coming from oil and gas. But if after this proposed demerger, we think that valuations are attractive, then I think Reliance will move into the investable universe. As far as Asian Paints is concerned, Asian Paints is not excluded. So yes, chemicals has certain ESG related issues, but a very, very detailed analysis of Asian Paints gives us the comfort that this is not as significantly polluting or as significantly dangerous as as fossil fuels, for example. So Asian Paints is very much in the investable universe, and it is very much in the portfolio as well.
Thank you, Mr. Abhay. Mr. Andrew, would like to give any closing note?
I saw a few questions on the fees, whether we should the fund fees. Whether Riddhi, you could put up that that slide for us, just so people can see what they are. So you can see that there's three options there. Option one is just a pure management fee. Option two is a management fee with a performance fee over a certain hurdle, and option three is really just performance fee over the same hurdle. So it gives investors a good range of what they would like to see from the fund, whether it's just pure management fee or just pure performance fee, because we're saying that we would and have proven that you do get alpha over the Nifty consistently. So I think that's a nice range, and there's a middle. Option two is a middle of the ground if people want to do that. So I think that's been taken well by investors. That it's given them some good options in terms of the fee structures and what suits them. Obviously, option three gives everyone. We have skin in the game to get that performance right to do that. So my closing remarks would be, ESG is going to be a growing area for India, and what got me interested in ESG was it was probably some 10 years back actually, when a certain tea company was featured on the BBC, where they were using children really as workers, and as soon as that was aired on the BBC, then all the buyers of that product, the distributors of that product, just stopped straight away. It killed their business. And so that was 10 years back. Now this is more prevalent in terms of what we're seeing today. And the younger generation, and I'm talking about the kind of everyone's age below me today, in terms of millennials and the Gen Z, this is very important to them. So if you just think about this whole movement of ESG investing, then you're going to have, we have 5,000-6,000 companies in India listed, but that will dwindle down to a smaller number. And unless those companies are starting to play by the same rules as everyone else, they're going to be excluded from investment. So you're going to outperform by having the right company who are doing the right things. So I'm not just trying to be judgmental in terms of, we have to do everything right for the world, but that's the way it's going. So whichever way I look at it, ESG is going to be an investment asset class, not just a kind of a theme that we're playing. It's an asset class, which is going to become all the long-only funds in India, mutual funds. I can see we'll have to have ESG principles brought in very, very quickly, because they'll be forced to by investors, by people who want to only invest in good companies, sustainable companies, who are also kind of looking after, all the things that Abhay mentioned, which, could be a problem. My view is that this is not going away from us. It's not a short-term theme. It's very real, and it's going to continue. And it's quite interesting that, even though I mentioned at the very beginning that special acquisition companies is something I worry about, interesting that the first one that they bought in India was a renewable energy. So the first investment the special acquisition company made was actually a renewable energy company in India. So that, I think, tells you what's going to happen going forward. So those are my closing remarks, apart from obviously thanking you and all the people who have participated today. And we're always happy to answer questions and talk people through. It's a complicated area, and I think the more education we can do, like you're doing today, the better I think investors will be informed.
That's wonderful, Andrew. And I'd like to thank Mr. Abhay and Andrew for taking their time and sharing the insights. And I hope the participant would enjoy it thoroughly. If you need any more details on the product, feel free to connect our representative, or you can write an email to info@pmsbazaar.com. So with that note, thanks gentlemen and thanks participants. Looking forward in hosting in another such event. Thank you very much.